Okay, let's just start with the number on the screen. The big one. The one that is probably flashing neon green on every financial news ticker across the globe right now.
Dow 50,000.
Dow 50,000. It is a massive psychological milestone.
It is. There's no getting around that.
It sounds like a victory lap, right? Confetti falling from the ceiling, champagne popping in the trading pits. I mean, if you look at that number in isolation, you'd think the economy is absolutely roaring.
Of course.
But then you slid this report across the table to me.
The February 2026 market report.
Exactly. And honestly, reading this gave me whiplash. It felt like I was looking at two completely different dimensions. Dimension A, stock market hitting all-time highs, everyone's rich. Dimension B, which is what this report details, describes a massive military buildup, unprecedented insider selling, and something called faux liquidity. It feels, well, chaotic.
The chaos is the signal, not the noise.
Yeah.
We're living through a disconnect, a very dangerous one. If you only look at the index number, that 50K, you see growth. But if you look under the hood, which is our job today, you see a structural shift. We aren't just seeing a standard market cycle here.
It's something bigger.
We're seeing the end of one world order and the messy, volatile birth of another.
So our mission today is to unpack that transition. We need to figure out why corporate insiders are dumping their stocks at a rate of 200 to 0.
That number is incredible.
And what a Desert Storm level military buildup in 2026 actually means for our listeners' bank accounts and this new concept that seems to be the engine behind it all.
PROSEC. Production for security. That is the key phrase. If you take one thing away from this deep dive, let it be that term.
Okay, so let's not bury the lead. Production for security. It sounds like military jargon. What does it actually mean, and why is it replacing the economic world we've lived in for the last 30 years?
To understand PROSEC, you have to look at how the world worked for the last few decades. The old model was the trade-based order. The priority was efficiency. You built things wherever it was cheapest. China, Vietnam, Mexico, you shipped them wherever they were needed, and the underlying assumption was that trade stopped wars.
The McDonald's peace theory, right. If two countries both have a McDonald's, they won't shoot at each other because they're too busy trading burgers and microchips.
Precisely. It was an era of just-in-time supply chains. But that era is effectively over. The source material for this deep dive makes it very clear. We are shifting to production for security.
PROSEC.
In this model, efficiency doesn't matter. Profitability is secondary. The priority is autonomy and defense. Nations are bringing supply chains home onshoring, not to save money, but to ensure they can survive if the global order collapses.
So it's no longer where can I build this widget for the lowest cost, it's where can I build this widget so that my enemy can't turn off the tap.
Exactly. And this isn't just a theory in a think tank paper. The report highlights some scary evidence coming out of the Middle East right now that proves PROSEC is already here.
Yeah, let's look at that. The report uses the phrase desert storm levels regarding military transport. That seems hyperbolic.
It's not. The data is specific. Since mid-January, at least 112 C-17 Globemaster aircraft have been deployed to the region.
Okay, for the listener who isn't a military aviation buff, 112 planes, is that a lot?
It's enormous. A C-17 isn't a small courier plane or a fighter jet. It's a massive, heavy-lift transport aircraft.
So what does it carry?
We're talking about a plane that carries M1 Abrams tanks, Apache helicopters, massive amounts of troops, and pallets of supplies. When you move 112 of them in a span of a few weeks, you aren't just sending a diplomatic message.
You're building a logistics tale.
You are setting up the infrastructure for high-intensity confrontation. The report notes that while politicians are talking about diplomatic efforts and potential talks on the news, the logistics tell a different story.
The hardware doesn't lie.
You don't move that much heavy metal unless you're preparing for significant operations.
And this bleeds into the economy immediately. The report mentions new secondary tariffs, 25% on countries trading with certain regional powers.
That is PROSEC in action. Think about it. In a trade-based order, you don't slap 25% tariffs on your friends just because they trade with your enemies. You want the goods to flow.
Right.
But in a security-based order, you force them to pick a side. It disrupts everything: supply chains, pricing, availability. But the priority is security, not the economy.
It's essentially weaponizing the supply chain. And it's not just the U.S. and the Middle East. The report mentions Japan, too. They just had a snap election.
Yes, and usually a Japanese election result is fairly predictable, but this one was significant. The ruling party won a landslide supermajority.
Which usually means business as usual, right? Stability.
In this context, it means a mandate for drastic change. They're shifting toward aggressive fiscal policies, sales tax cuts, fighting currency swings. Japan is effectively positioning itself to be an autonomous player. They see the global fragmentation, and they're ensuring they can stand alone if needed. It's another piece of the PROSEC puzzle. Nations are walling themselves off.
So we have a world that is rapidly arming up and locking down. But then let's pivot back to the financial side, because this is the disconnect that's driving me crazy. If the geopolitical world is getting this scary, why is the market seemingly so calm?
Right.
Why is the Dow at 50,000?
This brings us to the second major concept in the report, faux liquidity.
Faux liquidity, fake money.
Not fake money, but fake market depth. This is critical for any investor to understand. In the old days, you had human market makers, guys on the floor of the exchange who would stand ready to buy or sell. They provided a cushion.
Sure.
Now, market making is mostly done by algorithms, high-frequency trading bots.
Right. The algos.
These algos provide liquidity. They put up buy and sell orders as long as things are calm. They create the illusion that there is always someone there to buy your stock. But the moment there's a sharp move or a shock,
they turn off.
they pull their orders instantly. They're programmed to protect themselves, not the market. So the liquidity vanishes.
Oh, wow.
This creates what the report calls air pockets in price action. The price can drop drastically because there is literally no one there to catch it.
So the market looks deep, like a swimming pool, but the moment you jump in, the water drains out and you hit the concrete.
That is a terrifying but accurate analogy. We see the Dow at 50,000 and it looks robust.
Yeah.
But that number is floating on this algorithmic thin ice.
And beneath that ice?
Beneath that ice, there is a very real challenge brewing against the bedrock of the financial system, the U.S. dollar.
This is the de-dollarization trend we've heard whispers about for years, but usually people dismiss it as fear-mongering. This report says it's accelerating.
It's moved beyond whispers and conspiracy theories. It is documented and strategic. The report details a coordinated push for an alternative global reserve currency.
And it's not just talk anymore.
No, they're being smart about it. They're using a network effect.
How does that work in practice?
Start with trade settlement. If you and I are two emerging economies, say Brazil and India, or China and Saudi Arabia, and we agree to trade in our own currencies, we bypass the dollar completely.
Okay.
The report says some bilateral trade between major emerging economies is now nearly 100% independent of the U.S. financial system.
100%. So the dollar isn't even touching those transactions.
Correct. And once you establish that trade network, central banks have to hold those alternative currencies to facilitate the trade. It forces a shift in reserves. It's a slow stranglehold on the dollar's hegemony.
And meanwhile, back at home, our own Federal Reserve seems, well, confused. The report mentions policy whiplash.
The Fed is in a terrible bind. You have leadership transitions happening, which creates uncertainty. But the real problem is the split in philosophy. Some officials look at the labor market, which is showing cracks, and say, we need to cut rates to save jobs. Others say, no, inflation is still a risk. Policy needs to stay neutral.
And the market is just sitting there praying for a bailout. The legendary Fed put. Can you explain that for the listeners who might hear that term thrown around?
The Fed put is the belief that the Federal Reserve will always step in to rescue the stock market if it falls too far, usually by cutting interest rates or printing money.
Right.
Domestic institutions are vulnerable right now, and they are betting heavily that the Fed will save them if things break.
But can they?
That's the transition risk. With the dollar under attack globally and supply chains breaking down, which causes inflation, the Fed might not have the luxury of saving the stock market this time.
Wow.
They might have to choose between saving the dollar or saving the Dow.
Okay, that is a sobering thought. But I want to connect this back to the headline, Dow 50,000. If the liquidity is fake and the dollar is under attack and the world is arming up, is the 50K real? Or is it just a number?
The report calls it an inflationary lift. Think of it this way. If the currency is losing value, everything priced in that currency costs more. That includes stocks. The number is going up, not necessarily because companies are selling more widgets or becoming more productive, but because the dollar is worthless. It's nominal growth, not real growth.
And here's the part that really made me stop cold. The aha moment of this deep dive. The insiders. The people running these companies. If this was a real boom, they'd be buying.
I'm thinking so.
But the report tracks the sell-to-buy ratio. What did it find?
It tracked the most recent top insider transactions. These are CEOs, CFOs, board directors. The ratio was 200 sells to 0 buys.
Zero. Not a single insider bought their own stock.
Not in this data set is the ultimate vote of no confidence. These are people who see the daily sales reports. They know their order books, they know their margins, they see the prosec shift happening in real time.
They see what's coming.
If they believed their stock was worth the current price or that it was going to go higher, they would be buying, or at the very least holding.
But they're cashing out. They are selling into the rally.
They're handing their shares to the retail investors, the regular folks who are celebrating Dow 50K. It signals that the smart money, the insidest of the insiders, believes valuations are stretched to the breaking point
They're taking chips off the table.
before the faux liquidity evaporates.
Yeah. And it's not just the stock prices giving us warnings. The underlying economy, specifically the labor market, is showing cracks that look a lot like 2008 or 2009, but it feels different this time. Who is getting hit?
This is a crucial distinction. In typical recessions, blue-collar and service jobs often take the first hit. But the layoffs we are seeing in early 2026 are hitting a specific demographic.
Which is?
We are seeing levels of layoffs in software engineering, AI sectors, and middle management that rival the 2009 recession.
The white-collar recession.
Precisely. And this triggers a reverse wealth effect.
Break that down. We usually hear about the wealth effect making people spend more.
Right. Typically, when the stock market is up, people feel rich and they spend money. That drives the economy. But you have to ask, who owns the stocks?
The top 10%.
Primarily the top 10% of households. Now imagine those same households, the software engineers, the tech sector employees, are losing their high-paying jobs.
So even if their stock portfolio shows a high number, they stop spending because they don't have a paycheck coming in.
Correct. They clam up, they cancel the vacation to Europe, they don't buy the new Tesla, and since the top 10% of earners drive a huge portion of discretionary consumer spending, that pulls the rug out from under the economy.
So the market can be high, but the fundamentals are crumbling.
The consumer fundamentals that support those companies are crumbling.
That explains why the consumer discretionary sector is under pressure in the report. People are either broke or they are scared they're about to be broke.
Exactly.
So we've painted a pretty stark picture here. High risk, fake liquidity, insider sleeing, war drums beating, and a white-collar recession. If you're listening to this, you're probably thinking, okay, thanks for the nightmare fuel. But where do I go? What actually works in a prosec world?
The report is actually very specific about winners and losers, and it requires flipping your mindset. We already mentioned the losers. Software, specifically the IGV index, is oversold and volatile.
Yeah.
It was the darling of the last decade, but in a hardware and guns world, code is less valuable than steel.
And consumer discretionary is out. What about the Magnificent Seven, the big tech giants that have held up the market for years?
Even they are showing relative weakness compared to the broader S&P 500. They aren't leading the charge like they used to. The generals are faltering.
So where are the winners?
Energy.
Makes sense. If you're moving 112 C-17s, you need a lot of jet fuel.
It's deeper than just the fuel for the planes. In a world of conflict and inefficient supply chains, remember, prosec means we stop prioritizing. Efficiency energy becomes the most critical asset.
Right.
You cannot have security without energy independence. Energy is the standout outperforming sector in the report.
And alongside that?
Hardware tech. Not the software, but the physical stuff. Chips, infrastructure, robotics, the things you can touch.
An abundance mindset for physical goods.
Yes, real things for a real world. If supply chains are breaking, the companies that make the physical tools to rebuild them become incredibly valuable.
This brings us to the alternative assets. I see gold on the list. It's sitting near $5,000 an ounce.
It's stabilizing there after some liquidations. But the interesting note in the source material isn't just the price. It's the speculation about a digital currency backed by physical gold.
The gold-backed crypto. Isn't that the holy grail for the anti-fiat crowd?
It is the final play for trust. If the dollar's being challenged and fiat currencies are wobbling because of inflation and debt, a digital token backed by actual gold bars in a vault could be the bridge to a new financial system.
Combining old and new.
It combines the speed of digital with the trust of physical assets.
And speaking of digital, where does Bitcoin fit in? It's been a roller coaster lately.
Bitcoin is acting as the canary in the coal mine. It capitulated down to the 60K, 68K range, but found support. The report calls it a risk-on gauge.
What does that mean for the average investor?
It means Bitcoin is a detector for those faux liquidity shocks we talked about earlier. Because Bitcoin trades 247 and is highly sensitive to liquidity, If it crashes suddenly, it's often a warning that the algorithmic liquidity in the broader stock market is drying up.
So if you see Bitcoin tank on a Sunday night,
You might want to buckle up for the stock market open on Monday morning.
there's one more specific warning in the report that I want to flag. It says to watch a specific bank, JP Morgan.
JPM, the banking bellwether,
Yeah.
fortress balance sheet,
Why them?
because they are the leader. The report says if JP Morgan breaks down, meaning its stock price drops significantly through key support levels, it signals distribution in the banking sector.
Distribution is fancy trader talk for selling.
It means the big players, the institutions, are selling off their positions to the little guys. A breakdown of the banks often precedes broader market weakness. So keep an eye on JPM.
It's the early warning system.
For the financial sector, yes.
It really feels like we are walking on a tightrope here. The report also mentions policy whiplash, tariffs on coffee and beef being imposed and then rolled back because of political pressure.
That is the chaos of the transition. It makes long-term planning impossible for companies. If you don't know if your fertilizer or beef is going to be taxed 25% next week, how do you invest? You don't.
You just freeze.
You hoard cash. You cut costs. You look for stable legislative environments, which, frankly, the U.S. is struggling to provide right now.
And the report implies our neighbors are taking advantage of that.
Absolutely. Canada, Mexico, European partners, they are securing permanent trade infrastructure and joint ventures while the U.S. is flip-flopping on policy. They are locking in relationships that won't change regardless of who wins the next election.
So let's summarize this landscape because it is heavy. We have the Dow hitting 50,000, which feels great on the surface. But underneath, insiders are selling everything they can. We have a massive military buildup in the Middle East C-17s everywhere, signaling a shift to a security-first economy. We have a labor market that looks like 2009 for the people who usually drive the economy. And underneath it all, the liquidity is fake and the dollar is being encircled.
It is a time for extreme caution. The stability provided by that Dow number is superficial. It is a facade covering a lot of structural rot.
And for the listener, this means the old rules might not apply. Buying the dip on a high-flying software stock might not work if we're in a hardware and energy cycle.
Exactly.
Relying on the Fed to save the day might not work if they are fighting a currency war.
Precisely. You have to look at what the world is, not what you want it to be. And right now, the world is PROSEC, production for security.
Which brings us to the big question. We always like to leave you with something to chew on.
If we accept that this production for security model is real, if we accept that nations must now prioritize self-reliance and defense over everything else, we have to ask ourselves a fundamental question about the nature of business itself. Are we entering an era where profitability is no longer the primary metric for a successful company? In the past, the best company was the one that made the most money.
Right.
But in a PROSEC world, where supply chains are weaponized, where tariffs appear overnight, and where liquidity is a mirage, maybe the best company isn't the one with the highest margins. Maybe the best company is simply the one that can survive.
Survivability over profitability. That is a heavy thought. It changes how you invest, doesn't it?
Completely. You don't look for the highest growth. You look for the thickest armor.
And on that note, we're going to let you get back to your charts. Keep an eye on those C-17s, watch that JPM ticker, and don't let the 50K number fool you. Thanks for diving depth with us.
Stay safe out there.